How many lines of code did it take to get Bitcoin started?
Give me a simple definition of blockchain.
We have 150,000 lines of code.
I want this to be done in a way that even a 10-year-old understands the concepts.
The most important thing to keep in mind is this is a very, very young technology.
What determines the value of a Bitcoin?
We're going to take a real world asset and bring it into the digital world. Bitcoin, Ethereum, and digital dollar. It's a maturing asset class.
What difference will it make in the life of a consumer?
The speed that it moves around is just way faster. It's going to bring finances back into the control of people.
Would companies like Airbnb cease to exist?
Yeah, they might.
They might?
Okay, cool.
Welcome to another episode of the Neet Bherwani Show, where we dive into the latest trends and insights in the world of business and innovation. This is a special episode in collaboration with SuperBridge Summit 2024 happening in October, an event that brings together global leaders to tackle the challenges of our time and drive innovative solutions for the next generation. Today, we have Marcel Casamovic, the Deputy Chief Investment Officer at Coinbase Asset Management. Welcome, Marcel, to the podcast.
Pleasure to be here. Thank you.
The idea for having this conversation is I want this to be done in a way that even a 10-year-old understands the concepts. Because a lot of what we'll be discussing will be around Web3, will be around blockchain, will be around cryptocurrencies, and not a lot of people know these concepts. So the whole thing started with the introduction of blockchain, right? Like blockchain came and then Bitcoin was built on top of it. Give me a simple definition of blockchain, which even a 10-year-old can understand.
So if I were running a lemonade stand, I would have a ledger. Who was buying what and how much money I was bringing in. So think of the blockchain like a digital ledger.
Right.
So an accounting ledger. So then what are the unique features? Decentralized. You require no third-party intermediation. It's immutable or very, very hard to change the records.
Adding on, someone is running a lemonade stand. If a transaction comes in, like for example, someone buys a lemonade, everyone who has that ledger has access to it, right? And immutable, you're trying to say that once a transaction has come in, it can't be changed. And everyone has a copy of it. The blockchains came and then a lot of cryptocurrencies came after that, like Bitcoin being the most prominent. The value of Bitcoin, we have seen it go up and down. What determines the value of a Bitcoin?
The most important thing to keep in mind is this is a very, very young technology. So a lot of the volatility is just going to be by its nature, by its young nature. As it grows up, its volatility will dampen, and we're starting to see that now. In the context of valuation, think of it like a commodity, okay? So we're mining Bitcoin. This concept of mining is really just validating transactions. It's a way of encouraging people or incentivizing people to validate a transaction.
I want to also make it more simple. So for example, every Bitcoin, there's a block, right? And multiple transactions together make a block. Now these blocks are linked together and that's what makes
That
a
becomes the
blockchain,
blockchain,
right? Everything on the blockchain is run on computers. It's a network of computers. Before any transaction goes in, it needs to be validated, like so through these computers, and that's where the mining comes in.
It just takes a lot of computing power.
Absolutely.
So then that's the cost of validating a transaction. What's your reward? You get a little bit of Bitcoin.
Correct.
If you think of it in the concept of production, of a mining, lower boundary of the value of Bitcoin should be equal to the cost of mining. You can think of it as the energy that it takes to produce a Bitcoin should be the value of that Bitcoin. So then we can monitor this. Now, if there's no interest in Bitcoin, then the energy required to validate these transactions will come down, the value will come down. But if there's a lot of interest in Bitcoin, then the cost or the excitement about validating these transactions, the benefit of validating these transactions will go up. The energy costs will go up. So too will the floor value of Bitcoin, that lower value. As you deviate from that cost of producing a Bitcoin, then you're getting into what I would consider technological speculation. What will Bitcoin become? Much the way we'll speculate about a Tesla or a Google. It's we may be able to determine the near-term value based on its current production costs or earnings potential, but that forward value that gets incorporated into the asset will capture all sorts of different things. And I think of those things as largely technological in nature. So the further you get away from your cost of production, the more it's capturing those expected future technological features. And then that's the component that will generate more volatility.
Now I want to get into an aspect called as digital native assets. Digital native assets are assets which are completely digital. For example, A Bitcoin.
A Bitcoin
A
is a great
Bitcoin is a
example.
completely digital asset. There's no note which depicts an Bitcoin. Completely lives in the digital world, and it has a value based on supply and demand. Now, digital native assets like Bitcoin have become pretty significant, right? How has it evolved since the inception of Bitcoin?
How many lines of code did it take to get Bitcoin started? 15,000 lines of code.
Oh, wow.
Now we have 150,000 lines of code.
On the same Bitcoin.
Same protocol. So what's happened between those? We've generated improvement, right? And this is the beauty, the dynamism. It's true of everything we do, by the way, but the dynamism of these tools, they're not static. So as the demand changes for what we want this Bitcoin protocol to do, you add lines of code and you codify the things you want it to do, like create smart contracts.
Correct.
So the creation of smart contracts, which is dominated by Ethereum, Bitcoin's going to be competing with it soon enough, but it's dominated by Ethereum right now. The evolution of smart contracts just says, hey, if there's a simple way to codify a relationship that we have that can be automated.
I want to simplify the concept of smart contracts for the viewers who don't know it. So correct me if I'm wrong, smart contracts are automatically executed if certain set of conditions are met.
Correct.
For example, if going back to the lemonade stand, like if I have received the $5 for a lemonade, it automatically gives you the lemonade. For example, that's a basic way to put this. Even I think it's being used a lot in real estate. And like if X amount of dollars are transferred, the contract of that real estate is automatically put in your name. Give us more examples on that.
Basically anything parametric, anything that can be well-defined can be automated. Once you automate it, then you've taken away a lot of the middleman frictions that are costly to transacting. So it can be things like insurance. Imagine you have a house and you have disaster insurance that if there's a tornado that comes through at a certain wind speed, then you get a payout. Those are well-defined parameters. We can agree on the data, pipe that data into this contract. And if those conditions are met, you're paid. Anything that can be defined with simple parameters can be automated. And once it can be automated, then all of a sudden we're making that intermediation simpler and cheaper.
Going back to the insurance example you mentioned, like a lot of people struggle with insurance. The buying process of insurance is easy. Like, hey, someone has sold you that insurance. But when it comes to the claim, people who have been through these claims can come back and tell you, hey, the huge process that they had to go through. And if that can be automated, like even by a certain percentage better, that would, save a lot of time of the consumer.
The whole spirit of our being is to make things better. We innately do this. We're never satisfied. Yeah. So call it competition, whatever. And sometimes it takes ugly forms, war, whatever it may be. But there's always this constant struggle to move forward, never to be satisfied, right? And with that struggle to improve, you just want to make things better. So how do you make things better? You remove middleman frictions.
Correct.
The closer you can get people together in terms of their intermediation, the more efficient it's going to be, the more transparent it becomes, the less corruption that happens. It's just a much, much better way of interacting financially.
Now I want to talk about real world assets. For example, a car, a painting, So here is where a concept called real world tokenization comes in. Give us the simplest definition for that and how it works.
Now just imagine we're going to take a real world asset and take the properties of that asset and bring it into the digital world. So we'll have the legal form of that, the asset representation, the ownership. So we're going to take the digital properties of any physical asset and bring it on chain. You can think of that as a bit of a transition, that at some point those assets will naturally reside on chain. But in the initial instance, we have a bunch of physical assets around us that we would like represented on chain, see the efficiency benefits of moving them around, of selling them, of buying them. It's just taking that physical representation and bringing it into digital form onto the blockchain.
Correct.
Much the way a natively digital asset is born, this one will be migrating into the digital
tell us,
world.
What is the need for it? As a consumer, I can just go see it in person, purchase it. What difference will it make in the life of a consumer?
The easiest way to start with this is think of the most successful asset that's migrated from physical to the digital world, and that's digital dollars.
Okay.
Let's say the entire universe of tokenized assets is, call it 180 billion, so it's tiny. Of that 180 billion, 165 billion is stablecoin. So when we're talking about assets that have migrated from that physical world or or in this case, fiat currency, into the digital world, it's largely stable. What's the value of that stable coin? Its velocity, the speed that it moves around is just way faster than cash. Just the number of times it moves per transactions in digital form is about 30 times more than in physical fiat form.
Wow.
So now think about what that means as a cash holder. I need to hold less cash.
Okay.
Now, why? Because when I send you my digital dollar, it clears instantly and finally at any point in time with no intermediation.
Right.
Dollars, I have to go find you, I have to deliver it, or I have to use a bank and then the bank's open, the bank's not
And
open.
banks also have a time, right? They could take a couple
Exactly.
days, especially if the dollar amount
And
is
there are
large.
dollar amount limits and whatever it may be. The efficiency improvement. Now think of who's most attracted to that efficiency improvement. Somebody who wants to hold as little dollars as possible, right? So traders. So what are they right now? Why is the velocity so high? It's moving around as collateral. So I'm trading a bunch of Bitcoin on a levered basis. I have to collateralize that. I'm going to collateralize it with dollar stablecoin with as little as possible because I want to keep as much cash as I can to do other things. And then when there's a margin call, I can meet that margin call instantaneously. So the speed of execution is super important.
Right.
So then you build from that to other assets. Now, what I think will happen with other assets, it's still too early. Yeah. So people don't really know what to do with a digitally native asset. We're still learning.
Yeah.
You're going to start probably with payments and then build to other areas. So everything else to me is experimentation. We're just seeing how it goes. Primary use case that I would emphasize to demonstrate its value is the tokenization of the dollar.
So recently I came across this very interesting example. You know, this popular blogger, YouTuber, Logan Paul. He purchased the world's most expensive Pokemon. Okay. If I'm not wrong, that is a 1998 Pikachu Illustrator. Now he purchased this for $5 million or something of that sort. He tokenized that physical asset. Like while he owned a majority of the share, he put it out. Even you can own a percentage of this Pokemon card, which is the most valuable in the world, for as low as $0.1. And he put it up on the internet. Give us some other examples, that very successful examples, other than the dollar one, which you spoke about, where real life objects have gone through successfully.
So this is a fantastic example because I know nothing about it. So
Right.
that's why I really like it.
Yeah.
Because the 10-year-old might know more about it than me. But and I think right now it's about bringing community, right? So why does somebody want to be involved in a meme coin? There's a certain communal element that brings people together, and it's fraternal at some level. If I own a piece of the Pokemon and you own a piece of the Pokemon, then suddenly we have this little community that we brought together. We've come together for some purpose. There's something about this piece of art that we're attracted to that may define our common values, that may then define a network that allows us to engage and interact and grow and whatever it may be. So I think that's the spirit of it. Where we head with this, I think it's going to be really remarkable. The absence of intermediation and the efficiency of dollar movements or cash movements in digital form means that I can send you 1/1000th of a penny. That may seem pointless right now, but imagine you're wearing a Pokemon hat and that Pokemon hat is advertising to the world and it has a little NFT chip.
Right.
And Logan Paul says, if you're going to advertise my art, I'm going to pay, it's going to help the value of my art potentially. I'm going to pay you Micropayments. And depending on where you are, if you're at a football stadium,
payment could increase.
That payment could increase. So the micropayments that are now happening online that are going to a Google or whomever it may be, go to you. That is revolutionary. So that brings finance back to the people. It brings more control to the people. And then it's your choice. You want to wear the Pokemon hat and earn extra money? Great. You don't want to wear the hat? Don't wear the hat. But you're advertising for Nike. You're getting paid, not the intermediary. So I think these are where we're going to see enormous leaps to the benefit of individuals. And all you're going to need is a digital wallet. It's going to be super simple. And the simplicity of user experience is kind of what we're missing right now.
Right.
So we're exploring all these things, but until we get to the simplicity of user experience, we're a bit stuck because people need to capture their imagination around all these different things. The fact that we're even experimenting with them is a leap forward.
Imagine something as expensive as a Bugatti, which is $5 million, $6 million. Imagine I'm getting 1/12 of it. Whatever that dollar amount works out to, it's close to $500,000. And I get to own the Bugatti for 1 month in an entire year. Something like this makes that possible, right? This whole fractional ownership makes that possible. Even in the world of real estate, it's happening. Talk to us about the world of real estate and how fractional ownership is coming in.
This is a great example where you could see meaningful change. We have the stock of capital that we're underutilizing, and we can utilize it more effectively. So the more things we bring on chain, the more likely it is we're going to find ways to have uses for that capital. From a fractionalized ownership of real estate, you can do two things with that fraction. You can rent it out, or you can occupy it without the intermediary that creates all of these frictional conditions that limits what you can do with the asset.
Right.
I really feel like once we get into the world of fractional ownership, what we're really talking about is maximizing the usefulness of every physical asset that we have above ground, which can be true of clothing. It can be true of everything we own. So there's all sorts of things I think we can do to make the utilization of capital way, way more effective.
I own a property, right? And I put it on Airbnb. How is this particular thing different? Because there are a lot of rental portals out there where you can get versus it being tokenized.
I think it comes back to intermediation. And it's very important. So what have Airbnb and Uber and places like this done? They've said...
They've made it a marketplace.
Yeah. They've made a marketplace for excess capital. So you have a second home that you're not fully utilizing, let us rent it out. Oh, you have a car that's sitting idle, let us rent it out.
But they make a percentage of
They make
that.
a very large percentage.
Yeah.
Okay. And that's what every intermediary does. And that's a market friction.
Yeah.
What was the market friction? Is that nobody knew how to rent their house effectively to a third party. The alternative was I had nothing. And now using Airbnb, I have something.
Yeah.
And so it's fantastic service. What blockchain can do is just make that more efficient. So then the communities come together naturally. So then the important part of it could very well be the network of Airbnb is its power. And what they may realize is, oh, geez, we're going to get disintermediate. We need to integrate these blockchain technologies and these tokenized solutions into our framework, into our infrastructure, because it's way more efficient. And then we'll take lower margin, but our back office function, all of the paperwork, all the accounting will be way more efficient. We'll get more volume with tighter spreads, which was kind of the Amazon revolution. Right. So I think you could see an evolution that way. Rather than Airbnb disappearing, they just transform into more digital form. Ditto with PayPal, ditto with Uber, right? Where you're just giving a little more ownership and a little more representation to the people who own the capital and a little less away from the intermediary.
No,
I think that's the efficiency.
Absolutely. And I think like you're right. That was about to be my next question. Would companies like Airbnb cease to exist? But I think
they might.
They might?
Yeah, they might. I mean, this is the interesting thing with disruption is always, if you don't recognize a disruption, you're going to get run over.
Absolutely.
So PayPal's a really, really interesting example. So PayPal looks out the window and says, look, we have a great network. People use it because they recognize PayPal as a great network.
But they charge a huge amount. Like PayPal, like I send, like we work with a lot of freelancers and other companies. And when we are sending this, it's charging from both ends, right? It charges you as well as the person who receives it doesn't actually receive the full amount at times. There's a deduction happening.
No, I think they've recognized this payments evolution as well. So what are they doing in response? They're integrating digital payments into their infrastructure with Paxos. Super interesting. Are they a traditional company or are they going to migrate into a digitally native one? The past has been one where the IBMs of the world or whomever it may be have just been blind, or the Polaroids of the world have been blind to the disruption around the corner. Companies seem far more alert to it now. The idea that a traditional company is traditional and therefore disappears. It can just transform itself or pivot into becoming a digitally native company. And if you have a great network, that network is still incredibly valuable. Correct. That data is incredibly valuable. So they want to hang on to that for dear life. That's their value prop.
A brilliant example for a company not adopting to the digital space is Blockbuster. Netflix came in and they killed Blockbuster just by adopting the digital space.
Blockbuster had the opportunity to purchase Netflix early on at a fraction of its current value.
Right.
And they passed. The CEO thought it was just a passing fad.
That amount, if I'm not wrong, is $50 million.
$50 million.
And look at Netflix right now as $1 billion company. I think, if I'm not wrong, the Blockbuster CEO thought it was a joke Netflix coming in.
Well, and remember, I mean, initially, I was an early adopter to Netflix.
Okay.
Now, initially, it was a club. You bought either 1 or 3 discs at a time, CDs that were delivered to your home via mail, and then you mailed them back. So initially, it felt like a bit of a joke. I mean, I was working at Soros Fund Management at the time, and we would do swaps amongst us with these little CDs from Netflix. And everyone at that time who was using Netflix understood that this was a migration onto the internet. The value of Netflix now is the network, and it's a super powerful one.
What are some effective investment strategies for people who are looking to invest in the digital native assets?
Start small, stay humble.
Number 1.
What does it mean starting small? 3 assets in the digital landscape account for 76% of the total market capitalization.
And what are those 3?
Bitcoin, Ethereum, and digital dollar.
Amazing.
It's a maturing asset class. So you have all these meme coins that are super interesting. There's a reason why institutions are starting with Bitcoin, then Ethereum, and then effectively tokenized money market funds or digital dollar, because those are the ones that are best understood. That'll give you the most opportunity to deeply understand what's actually happening. How do they differentiate? How do they make money? What do you expect these things to do over time? Learning from the volatility that you mentioned earlier in the conversation, which is super important. Managing that volatility in maybe a broader portfolio. I think that's a natural place to start.
When you talk about real world assets, right? How does it fit into a diversified portfolio?
The real world asset market is it's too immature. So the only real thing you can do in real world assets today from a portfolio construct is to be long the dollar. In one way, long the dollar.
Loan the dollar.
Long. Yeah.
Long dollar.
Yeah. Be own dollars.
Okay.
Right. So you can own dollars either through stablecoin, or you can own dollars through the next most successful asset, which is taken off this year, which is tokenized treasury bills. So you can do those two things fairly easily. But if you think of it in the context of the future, the solution that digital brings to an investor as they start thinking about their portfolio construction is a specialized solution to you, which is very, very different from today. Today, you look at a screen and there are a million different choices to select. Now imagine a world where all of these assets get on chain, and then I'm creating a desired portfolio by words. I say, I think inflation is going to be very high and I want inflation protection. And through all these natively digital assets or tokenized assets, a portfolio is presented to me as a potential solution to that problem. Right. And I can look at the analytics of that portfolio, whatever it may be. And that portfolio may include tokenized real estate. It may include an emerging market bond. It may include all sorts of things that may not have been obvious to me as an investor. So I think that future, the more assets we bring on chain, we consider specialized solutions we can deliver to an individual person that gives them more control over their finances.
What are the main regulatory challenges that you see facing tokenization in different regions?
The position that I take on these issues is very simple. If you want these technologies to scale, they have to enter the regulatory mainstream. They just have to. And that can be frustrating. Finance is just different. When you're moving people's money around, it's different. The stakes are higher.
Yeah.
So the level of conservatism is naturally higher. So as you institutionalize the asset class, you're just going to have to go through the natural progression of integrating into current regulatory environments. And that's going to take time and patience. The clearest example, money travel rule. They're just rules. And you and I adhere to them. And we probably aren't even aware of it half the time. But beyond a certain threshold of money moving around the world, it's recorded. Yeah. And it's recorded by your account and by your name and whatever it may be. And 99.9% of the time, it just doesn't matter.
Yeah.
Because we're all good operators. So we don't notice. It's not drawn upon. It doesn't matter. But if we're moving digital money around, that money travel rule is going to apply. We're going to have to figure out how to integrate the money travel rule into our movement of monies around the world. That's a clear example. Now, an example of where entering the regulatory mainstream is important. Think of the ETF and the success of the ETF for Bitcoin.
For the audience who does not know ETF, please elaborate.
So an exchange traded fund typically takes assets that are difficult to access or maybe potentially a little more complicated and delivers them to you in a single unit structure. So it could be a bunch of emerging market bonds. You say, I like emerging market bonds, but I really don't want to be an expert in all of those bonds. So then they produce this thing called an exchange traded product linked to emerging market bonds. And there's an expert behind the scenes that says, all right, we're going to follow this index. Here are the bonds we own, very transparent. And now if I want to be long an emerging market bond, I can just buy this ETF on a stock exchange.
Right.
Super simple. Integrates into my system. Super simple. So typically it's making a set of assets that are very complicated simpler. Now, the ETF for Bitcoin, the features of Bitcoin are better than the features of the ETF, which is interesting because Bitcoin trades 24/7, 365. The ETF doesn't, right? The ETF is more constrained, yet the demand profile was enormous.
Okay.
Now, why? How can it be that we put a wrapper around Bitcoin that lessens its qualities and demand goes up? Well, it goes up because of the delivery mechanism. So with BlackRock or whomever, whatever institution is delivering these mechanisms, so you have the strong infrastructure behind it, and you have BlackRock as the lead example of running these exchange traded products. It still may be volatile, may go up and down, but at least from a regulatory perspective, it's appropriate.
Correct.
So now all of a sudden, when you walk into an investment committee and you want to buy Bitcoin, this is a very, very simple argument to make now, where we don't have to worry about the regulatory compliance because it's entered mainstream institutions. So I think we're going to need to see that pretty much across the board in the space, which again, it slows the progress for sure.
Yeah.
But that's okay. That's part of the journey.
Correct. And how is your company Coinbase navigating these regulatory challenges?
The tools we're building are built to scale with the regulatory mainstream. So for example, my position in the United Arab Emirates and Abu Dhabi in particular is working with ADGM to bring a tokenized platform to the mainstream.
Yeah.
Now we're doing that very deliberately and very slowly. Every single transaction that we're doing has to be approved by ADGM until we have a regulatory framework, complete regulatory framework in place. So our approach has been to work with regulators side by side patiently. Takes time, slows us down for sure, but patiently to then end up at a place where we have a tool that can scale into the regulatory mainstream. It's absolutely essential.
What do you see as the future of digital native tokens or real world tokenization? Where is this all headed?
It's going to bring finances back into the control of people.
Yeah.
As we eliminate intermediation, it definitionally means I have more control over my personal finances and over my personal savings and things of that nature. So the way I would think about that future is that as more and more things get on chain and become digitally native, then the solutions that can be provided to me by people from a meritocracy standpoint. So I see a problem that I can solve, and I provide that solution. I'll be rewarded for that solution.
Right.
You'll consume that solution. So you've flattened the economic structure massively through this decentralization and disintermediation. So that's a really lovely state. You get much closer to a pure meritocracy again and away from this cabal of centralized control. And I think that's a world where people can be generally more satisfied.
Absolutely.
So I hope that that's the future we end up with.
Amazing. And what about immediately, like say right now we are in 2024, say in the next decade, like till 2034, 2035, where do you think this would reach at that stage?
What will be very interesting is to see where these digital asset technologies capture users' imagination. And I think micropayments can be it. And I go back to this advertising example. We're all advertising. I'm advertising for the Louvre on my lapel, right? And we do it freely. Now, once those micropayments are no longer on the internet or a macro payment on a big billboard in New York Times Square, all that income and all that money can be redirected toward the individual. Once we appreciate the breadth of what micropayments can do and the control that it can give to the individual, then we're all natively digital. Because if I'm going to take a micropayment, I need a digital wallet. And if I need a digital wallet, then maybe it's Coinbase wallet. If I need a Coinbase wallet, then what's the banking intermediation behind that? Okay, then we have this long, deep conversation of, well, what's a wallet? How does a wallet integrate into the Federal Reserve System or a broader central bank system? All those things will be interesting, but I think we need a user experience to capture the imagination of individuals. Certainly things like meme coins are a start because it brings people together, but I think micropayments and ways that they can see that it's impacting their daily lives, that can be it. And I think over the next 10 years, we can see a massive evolution.
How do you see the impact of this particular nation adopting such changes?
It's a hub.
Yeah.
It's a hub. Having a tailwind where people want to get things done the right way is just a really, really lovely experience. And what I find what's happening now, I can have meetings every day of people from other parts of the world that are contemplating moving here. And they want to know my experience because I'm still relatively new. And my declaration is I'm not leaving.
Yeah.
Like, I'm here. Right?
Right.
It's very promising because what ends up happening with these new financial centers is they do become hubs. They don't become the center of the universe. They just become a hub for then educating or influencing other areas. And I think we're going to see a lot of that.
What do you want our audience to take away from this podcast? Any insights that could be useful for them? Key takeaways.
Single most important thing for people as they think about this digital evolution, this crypto technology evolution, is that it brings more control back to them and their personal finances.
Yep.
Control of their data, control of their finances, control of how they allocate those finances. As we get better at things, we remove intermediation. By removing intermediation, it gives you more control over yourself and your finances, which gives you more agency to do the things you love to do.
Absolutely.
Evolutions are difficult, right? They're not easy. They're not happy places. They're difficult places. But the other side of it is a better place. So I think the struggle is going to be worth it. And I think that's something people really have to look forward to. And then the most important thing is to engage. The only way you're going to figure out how this stuff works is to engage.
Yeah.
So get engaged, stay humble, learn from your mistakes and keep growing.
Marcel, it's been a pleasure.
Thank you, sir.
Thank you so much for sharing your insights.
I really appreciate the time.
I had an amazing and insightful conversation with Marcel, and you can get to do the same if you join us in the SuperBridge Summit. This conversation that we have had is powered by them. It's happening in the month of October, and we leave the details in the description below. Until next time, to another amazing guest. Thank you so much for watching.
Okay, cool.